This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, welcome to the latest edition of the AJ Bell Money Markets podcast. I'm Dan Coatsworth, and this week I'm joined by Charlene Young to talk about all things investing and personal finance. Hi there, Charlene.
Hi, Dan. We've got some interesting things to talk about on this week's podcast, including why AJ Bell wants to see major changes to ISAs and what did and what didn't make it into the King's speech.
I'll be talking to James Lowen from James Hambro about why he's been selling shares in housebuilders despite the sector seemingly benefiting from a Labour government. The fund manager also explains why he's been buying shares in EasyJet despite the airline cancelling lots of flights this summer, and why ITV might have scored at the Euros.
Gold has had a good run this year, but some of the gold miners have been left behind. Rob Crayfourd from the Golden Prospect Precious Metals Fund is on the show to explain why this has happened and why the miners could soon play catch-up.
Now, Charlene's been scrolling through Instagram, which I'm sure is not allowed at work, spotted a debate about whether handbags are better investments than shares.
I have, but first up, let's take our usual look at how markets have performed over the past week. Dan, we've had some important data about inflation and jobs, and how did they affect the UK market?
Yeah, I mean, this is probably one of the most eventful weeks we've seen in ages. So we'll start with the UK market. Lots going on there. So we had the latest inflation figures, 2%, bang on target with the Bank of England. Unfortunately, if you dig into the detail, you had services inflation in there at 5.7%. So still way much higher than I think the Bank of England will be comfortable with. So the Bank of England, of course, looks at inflation data, it looks at jobs data when it's making interest rate decisions. So come 1st of August, our next decision, it increasingly looks like we're not going to get an interest rate cut. So the data's just not there to support it. We also had, as we're recording this, we just had some jobs figures and wage growth still looks probably too high to warrant the bank cutting rates. So of course we had a little wobble with UK stocks, particularly stuff like real estate. It's obviously linked with interest rates. So the idea that rates will stay high for longer. Lots of people still priced out of the property market, and even commercial sort of property. You have to think that people are borrowing money to buy that, so that higher rates makes it less sort of attractive to do so. But we've had quite a few things happening in the US as well, and that actually triggered a bit of a sort of a rotation into some of the really boring stuff on the UK market. So tobacco, telecoms, utilities. I don't think anyone really gets so you don't think people get excited about wanting to invest in them, but they're sort of classic defensive. They do the job because it's low growth, but I think people look at them thinking, okay, they're a bit more reliable. So we've had a real choppy US market, and that has driven people to look at this. So actually, as we're recording this, the UK stock market's having its second day in a row, doing all right actually.
And so what's been going on in the US?
So we've had some of the best known companies on the stock market that have done really well over the last couple of years, have all been sort of concentrated in the technology sector. We've had a real big sell-off in tech stocks. Now this is linked to geopolitical risks is probably the easiest way of describing it. So first of all, we had the Biden administration sort of hinting that it might get heavy on the semiconductor sector. And what it's trying to do here is it wants to stop China getting its hands on the latest technology from foreigners, particularly from the US, that could help its military. So there's already some restrictions in place now, but it's talking about potentially making them a bit more stricter. So there's a company that's linked to the semiconductor sector called ASML. It makes up equipment that's needed to make chips. So they came out with some results, and whilst the results were fine, it was a big reminder in there that half of their earnings come from China. So on the same day these results came out, we had this speculation in sort of the media that the US was looking at ways to get heavier. We also had Donald Trump say about Taiwan that he thought that they should pay for the guarantees that the US gives them on defense. Now, ever since the incident with Trump last weekend, there seems to be a greater chance of him succeeding in the presidential election. So the markets are looking to see what impact will Donald Trump have on the markets, and the idea that if he's now sort of upsetting relationships between the US and Taiwan potentially, what does that mean for the stocks? And of course, Taiwan is a real big center of manufacturing in the semiconductor industry. So, even NVIDIA, the big US company, has lots of its stuff made in Taiwan. So you add all these things together, and people going, well, hang on a minute, crikey, we've got to think about all these risks. And so it's led to this big sell-off in US tech stocks. Against that backdrop, we've had a really big rally in US small cap companies. Now, these are very much unloved for quite a few years. It does look like a bit of a rotation. So people are looking at value. And of course, that's particularly why the UK stock market's been doing quite well in the last few days, because it's full of those boring things that do well when people are a bit uncertain about the market. So I guess if you're listening to this and you haven't looked at your portfolio, you might want to have a quick peek. There's a high chance that things are moving around quite a lot. But the key thing is don't get unnerved by it all. Try and stay calm. This is actually sort of quite normal that we go through these sort of choppy ups and downs of the market, but I guess a good diversified portfolio hopefully means something. If something's doing bad in your portfolio, you've also got something doing okay.
Exactly, yeah, sort of take stock, but don't make any rash decisions.
Yeah. We've also had the King's speech as well, which happened on Wednesday. So this is sort of Labour's blueprint, mentioned everything from infrastructure to football, but we're always looking for stuff for financial angles. So there's some pension stuff in there. So I guess, Charlene, what was mentioned and perhaps what was missed from it?
Yeah, so listeners might have seen the headlines where government claims that the new pension schemes bill and its measures could mean the average earner could have over £11,000 more in their pension pot by the time they get to retirement. So many of the measures in this proposed pension schemes bill are going to lean into the theme of increasing pension fund investment in the UK economy. So consolidation of people's pension pots is an important first step that the government hopes will place schemes in a better place to invest in UK private assets and the newly created National Wealth Fund. So a lot of the measures announced will initially apply to workplace type schemes, but we'll obviously be keeping a close eye to see if the rules might move into the private pension space too, as we've seen with other measures in the past. Now, in terms of what was missing, one key thing for me was any mention of scaling up auto enrolment. So that really important bedrock of getting people saving for retirement. Now, we know that minimum contributions need to rise. In 2017, a review of auto enrolment also recommended removing that lower earnings band. So contributions start from the first pound of people's earnings, and also it recommended that you reduce the minimum age to 18. That was missing from the King's speech. The legislation is already there. So the question really is when? We were disappointed not to see any movement on that. And why is that important? Well, removing that band so that saving would actually start from the first pound of people's income would actually add an extra £500 a year to most people's pensions. And over a working life, that could really, really add up.
I think lots of people, awareness of saving to pension, even younger people, is definitely growing, isn't it? So it does seem strange why they're sort of not pushing this through. But
yeah, it's a strange one. I mean, like we say, the legislation's there, so it is really a case of when. And of course, we're going to be mindful of cost of living pressures, particularly for those on lower incomes. But it's all about protecting yourself for saving for later lives.
Should we bring on our first guest? We've got James Lowen, who helps to run JOHCM UK Equity Income Fund. He's been making some pretty interesting and topical trades recently.
So the views that James will discuss are, of course, his personal views and shouldn't be taken as investment advice or recommendations to buy or sell shares.
So, James, we've got a Labour government in power now. The policies seem to be pretty good for the housing market. Now, in your fund, I noticed that you've actually been selling down positions in a couple of house building stocks, Bellway and Vistry, but buying shares in Forterra, the brick company. So does that sort of imply that you think building material suppliers are now going to be a place to deliver better returns than house builders, where perhaps is it all the sort of potential good news is already priced in?
Yeah, I think you're right in terms of the policy agenda. I think we've been in limbo on housing and other areas for 3 years. So it's been very good to see Labour Party policy and what they've done in the first few weeks in terms of the intent of moving up to 300,000 housing starts. We're around half of that at the moment. In terms of the fund, we're very well positioned for 10% of the fund into the housing value chain is how we look at it. We've got 2% of that is in house builders, and then 8% is what goes into houses. Some of that's building materials, some of that's retail. The reason we've been changing the mix, as you've picked up rightly in your question, is that house builders have rallied and priced in a lot of what's going to happen going forward. If you remember, they fell off a cliff really when Truss had her budget, and since then they've broadly doubled or more. So they've been the place most investors have gone to as they've seen the new policy sort of framework come through, and also interest rate cuts have come into view. That's the other key driver here. So we've been reducing our house builders. We're not saying they're fully valued, but they're closer to fair value than other parts of the market. So where we've been adding to exposure is in these other areas, including the company that you mentioned, Forterra, which is the second largest brick company in the country. And broadly, when we look at the valuations of all of the stocks in my 8% bucket, including those stocks can double. So this is basically looking at where valuations are and valuation anomalies within the same value chain.
I mean, you already own Ipstock, so you've been buying Forterra. I mean, I'm just wondering, it isn't, the supply of bricks in that sort of commoditized space. Why do you need to own two stocks? Couldn't you just put double the amount of money in one stock, sort of thing?
Well, both of them have got similar valuation dynamics. Forterra, when we bought it, was slightly cheaper than Ipstock, but they both fit into this doubling category. We look at everything, just to give you an insight into how we do things. We look at normalized earnings. So what could this stock in this sector, with this macro, with this policy rates, with this management earn? And we think both of them in a recovered market could make 30p of earnings. And you can see where the share prices are. We own just over 5% of Ipstock, I think. So it's good not to go to such, a high percentage of a company. So that's why we added Forterra into the mix. And as I've sort of said, and with this 8% bucket, we're quite well endowed in this area already. So just adding Forterra just was a rotation as we continue to sell down those two house building positions you said we had. We still want to own, our biggest position in house builders is Vistry, and Vistry is the market leader by quite a long way in partnership homes, which feeds into affordable homes. And obviously, one element of the Labour Party policy, which I think we'll see more of in the next few weeks from Angela Rayner, is what they're going to do on affordable homes. So Vistry plays into that. But the sort of different things we're doing in the fund definitely comes back to valuation.
So, I mean, just one more question, just about the sort of the house builders and Labour's policy. I mean, the idea is that they want to encourage building in things like disused car parks or wasteland, the grey belt they call it, isn't it? Is there a sort of danger that actually it takes ages to make these changes to the planning system, and that we could, whilst you think that Labour is a good backdrop for house builders or brickmakers, it might not translate into lots more work or lots more earnings for a while. Is that something that you're slightly worried about?
Well, that's a very good point. And one of the reasons we've been selling house builders is they've broadly priced in that we're going to get a full return, a full recovery in volumes. I do think it will take time, notwithstanding the intent they've got to change the policy levers. But when you look at my 8%, including the two brick makers we've talked about, I only need to get to 225,000 new homes. I don't need to get to 300,000. So we're not assuming, and we never do, that things will be perfect, everything will be delivered as they've said. But for all of my 8% bucket, we need to get back to 225,000. That's a very good increase over where we are at the moment. We're about 140,000 at the moment. So that's the scale of the increase we need to get to those normalised earnings I talked about on those stocks.
Okay, so the other one I want to talk about is EasyJet. So, I mean, the idea is coming out of the pandemic, lots of people going, really, really want to go on holiday still. Travel demand's been really strong. But if you took a sort of step back and look at EasyJet's share price over 3 years, sort of implying that things aren't as good as that. So I thought it was quite interesting because the company's done a very good job building up its package holiday arm from next to nothing. But what is it that the market's worried about, and why have you been buying more now?
So I think there's, unfortunately, and I think this will change with things like the holiday business and other value drivers coming through. The airline sector is very short-term orientated, very hedge fund driven. And so people, the shares tend to trade around more so than other sectors, like the ones we just talked about in the housing sector, for example, around short-term news flow. What's happening to prices this month for airline tickets? What's happening next month? Rather than take a long-term view. Now, I talked about normalised earnings on the housing sector. We do exactly the same with EasyJet. And EasyJet have helped us. They've laid out what they can make per seat on a sort of medium-term basis. It's £7 to £10. We think they'll get to £10. Now, if you ask the average person in your listener base how much they make per seat, most people would say a lot higher than where they are at the moment, which is about £5, and probably a lot higher than this £7 to £10. So £7 to £10 is their target. That would give you £1 of earnings. The share price is just less than £5 at the moment. And when you look at the drivers to get there, they're very clear. So, and some of them are like night follows day. So they've got an order that goes out over the next 5 to 6 years with Airbus. They're one of Airbus's biggest customers, and they're larger, more efficient planes than the ones that are going to be retired. That will deliver profit growth per seat. You mentioned the holiday business. It's astonishing. That started basically at zero about 5 years ago, and now it's 5% of the package holiday market. It's the cheapest operator because it's got no legacy systems, more flexibility. So it's resonating with consumers. That business, their target is it's going to make 250 million. We think this year it will make about 190. 250 is their medium-term target. That's part of the £7 to £10 per seat. So there's quite a few really big drivers that are going to drive us up to that sort of profit target that they put out. But the share price is dominated by this short-termism, and that's where you get the opportunity, Dan. You know, that's what that's the sort of hallmark of our fund. Over the last 20 years, we've been doing this, just taking a slightly longer view, looking at the structural changes and some of the strategies managements have got, rather than just looking at what's happening now. We talked about the housing sector. Everyone until about 2 months ago was worrying about what's happening now, which is very difficult. But now the market lens has elongated because of the policy action we've seen from Labour and this interest rate turn that we're likely to get in the next few months.
So, I mean, I guess you do need to sort of be aware of what's happening short term, or what the market's sort of concerned about short term, because it's I was just looking at social media and I could see lots of people complaining about EasyJet flights being cancelled this summer. I guess it seems to be, if you look at Jet2, it's sort of saying, people are leaving it really late to book their flights. So you'd think actually short term EasyJet got quite a lot of stuff to deal with. So it might be that you've been buying more, but potentially you could buy it at a lot cheaper price if these worries translate into sort of a short-term trading blip, I guess you could say.
Well, just on those 2 points. First of all, going back to valuation, the price at the moment is not far below replacement cost. So there's a lot of defensiveness in the valuation. So I think you've always got to come back to valuation. In terms of the two specific points you made, we've obviously had an election, and that's just caught people up, I think, in terms of making long-term plans. I think that consumers' focus will elongate out, partly because that's in the rearview mirror now, and also the other things we talked about, like interest rate cuts. In terms of disruption, it is an issue, but it's less of an issue, I think, this year versus last year. If you go back to last year, it cost them nearly £250 million in terms of the disruption cost, and a lot of that was driven by things outside their control. And the two main drivers were strikes on the continent with air traffic controllers, and then specific issues at Gatwick. And they've done a lot. And we had a call with management recently where we spent probably a quarter of a meeting talking about this. They've done a lot working with Gatwick to put safety measures and defensiveness in to the Gatwick operations, but also their own operations, just having crew arrive 15 minutes earlier than they did before, having more spare units in their framework, so they can bring those in if there's a technical issue. So they've done a lot of work, and so in our estimations this year, we think that $250 million figure will be a lot lower.
Now, before you go, can I just ask about ITV, which I know is also in your portfolio? So the company has results coming up. I guess I presume, they must have benefited from advertising around the Euro Football Championship. Clearly, it's going to be a one-off boost. So what's the actual situation with the company longer term?
We've got the studios business, which we think is worth more than the whole market cap at the moment when you look at valuations. So that's one thing. And then on the media ITV side, there's two things. One is the advertising, which has been boosted by the Euros. But if you take that out, it's doing better than people think because of a cyclical upswing. So the UK GDP was better last week, for example. And also FMCG has structurally underspent on advertising, and that's basically coming back now. And then the chief executive, Charlene McCall, has done a lot over the last 5 years on bringing it into the 21st century. So things like the data, things like what she's done on ITVX. So basically, if you watch ITVX, they'll know it's Dan Coatsworth, and they'll know you're into buying EasyJet holidays or Car X, and the advertising will be linked to what you're focused on. It's called addressable advertising, and that's much more valuable. So they've done things like that, which are now starting to bear fruit. So I think we've got cyclical tailwinds behind us, helped by that one-off Euros. We've got the stuff she's done, which makes it a much better business. And then we've got the studios business. And you've got to remember, it was one Friday out of this year, we had the announcement they're selling BrickBox. Okay, no one, was focused on BrickBox because it hardly made any money. This is BrickBox overseas, and they sold it for 10% of the market cap, right? On a PE of 55. Now, ITV at the time was trading on a PE of 7, depressed earnings. So there is lots and lots of value in these companies, and managements have started to try and exit out it themselves, like with the BrickBox sale, or there's been M&A. I mean, we've had 5 takeovers in 60 stocks this year, and it's because the valuations are so low.
That was James Lowen from the JOHCM UK Equity Income Fund.
Now, some of you might have already read about a campaign by AJ Bell to simplify saving and investing, but we thought it was worth explaining what's going on the podcast. So, Charlene, tell us about what AJ Bell is sort of suggesting.
So, our overall call probably isn't that new to some people. We feel ISAs have become far too complicated. There's far too many different separate ISA products, and we just want them simplified. We feel like by combining all the best parts of ISAs into one product, it would actually make it easier for people to take their first step into investing. Now, listeners to the podcast will know, of course, about all the potential benefits of long-term investing, but HMRC's own data suggests that there's around 3 million people in the UK with £20,000 or more saved into cash ISAs, and quite substantially more in some cases, but no money invested in stocks and shares ISAs. Now, if just half of that money was invested for the long term, we've worked out that could mean an additional £30 billion of investment moving from cash to long-term investments, and that could be unlocked. Now, the government, in our view, should create a single ISA product incorporating cash ISAs, stocks and shares ISAs, junior ISAs, and that innovative finance ISA. And under those plans, providers would be free to choose which investments to allow into the single ISA product or cash as well. So rather than them being distinct products, we think that merging would make it simpler for those holding money currently in cash ISAs to then transition towards that long-term investing without having to change product. Further measures that could be introduced after that initial simplification could actually then encourage money to flow to UK businesses. So, for example, increasing the ISA subscription limit rather than that brand new UK ISA idea, or also getting rid of stamp duty on UK shares in an ISA. That would all help towards the government's big focus on driving investment into UK PLC.
I guess the government's got a very long list of things to sort out, but I think it's important that they don't lose sight of thing. I mean, and to be honest, if you look at Labour's manifesto, that they talked a lot about wanting to encourage companies and wanting to encourage, pension funds doing stuff. So I think that there seems to be a sort of the will is there, isn't it?
Yeah, there's definitely an appetite. I mean, they did also mention, trying to simplify ISAs as well. So hence why, Michael Sumsgill has written to Rachel Reeves to outline our plans and thoughts.
Well, thanks, Charlene. Now, before we bring on our next guest, just want to mention about a couple of changes to the podcast over the summer.
Yeah, as with previous years, we're going to take August off, which means next week's show is the final one until the end of the summer. We'll be back at the start of September with both the usual podcast and the monthly investment trust show. Feel free to dive into the archives if you can't wait that long, of course. But for now, we've got time for one more segment, and it's a shiny one. Gold has been a good place to put your money this year, but gold miners have surprisingly lagged behind. To tell us why, let's bring on Rob Crayfourd from the Golden Prospect Precious Metals Fund.
So, Rob, I think a lot of people hold gold in the belief that it's one of the few assets that either holds or increases value when everything else is not going well in the world. Why has it jumped a lot in price this year, where you could argue there hasn't really been a lot of bad news around?
It's a really good question, and there's been a lot of people asking that same question. We've had gold at all-time highs, and a lot of major press agencies have kind of been citing it as hard to explain and trying to justify the reason. And it's not common that you see gold at all-time highs and S&P breaking all-time highs. I think we've had 36 breaks of all-time high this year already in the S&P. So for many people that doesn't kind of make sense. So look, I mean, there's a number of factors that impact gold, and I think it's important to take a step back and kind of look at what those drivers are. It was around about 2 years ago that we saw a real breakdown of that kind of clear correlation or inverse correlation with rates, as we saw rates breaking higher and gold has continued to tick higher, and that certainly left many people, certainly in the West, sort of questioning what the driver of that is. So I mean, if I appreciate that we've got a short time and we could spend a long time on this question, but those sort of near-term drivers have been primarily has been increased Chinese demand. So we've seen a real shift there from Chinese retail, and we know this because we're seeing sort of anecdotal data, but also a steady premium for Chinese gold over Western gold. But that's been the more short-term driver of that break from 2000 up to the sort of 2,350 level that we've been holding more recently. But behind that, there's also a number of some bullish longer-term themes that continue to play out. So we've seen steady central bank demand, and that's following Russia, Ukraine, and we're seeing countries around the world looking to diversify their treasury holdings, which kind of generally steadily been selling those down. Gold is an obvious beneficiary of that as they look to reallocate that capital. Government debt continuing to increase globally. I think there's real question marks about how long can that continue, particularly in a higher rate environment. I think that's kind of brought that kind of expanding debt that we're seeing in the West, primarily US, Europe, France, more recently with that recent election has kind of put that into question. But I mean, we're also seeing kind of economic data starting to soften despite stock markets at record highs. And I think, that kind of past correlation, inverse correlation that we talked about with rates, despite having broken down, it hasn't gone away. It just hasn't been the main primary driver of the gold price for the last 2 years. But still, I think there's that expectation with inflation having eased and softening data on that front, and therefore expected rate cuts coming out of the US Fed and certainly in the UK, where we're seeing softening inflation data, that will still be a positive driver, just not the primary driver that we've seen over the last 2 years. So I think there's expectations so that should kind of kick on. But I could continue talking about this for a long time, but I think there's many reasons for investors to hold some exposure to gold. We've got continued heavy deficits, global debt, strong Chinese demand, as we talked about. Primary drivers there being that weak property sector in China, which is leading Chinese investors to diversify away from one of their main areas of investment, and adding to gold as a source of protection.
I know that people who do want to invest in gold, they've got various options. They can either buy a tracker fund which just tracks the price of gold. They can buy the sort of gold bullion, physical gold, or they can put money into shares in gold miners or gold exploration companies, but I certainly know from sort of discussions with people over the years that if you've got sort of an interest in investing in sort of the gold mining sector, there's a sort of a widespread belief that if the gold price goes up, gold mining shares should do even better. But actually, I was just looking at just a casual few examples of gold miners. It doesn't seem to be particularly the case in sort of perhaps not in recent years that things aren't moving as you expect. What is that down to? Sort of cost pressures for mining companies, or is it just general they're having bad luck with production or exploration work?
Yeah, no, and that's a very fair question. Yeah, I mean, what the point you're making there is, the miners should have operating leverage. So, for simple maths, if you say gold was at $2,000 per ounce and costs are at $1,000 per ounce, a 10% increase in gold should be a 20% increase in effective margin for the miners, and therefore they should outperform gold in a stronger market. As you highlighted, the miners have underperformed gold, and the reason for that, as you flagged, is cost inflation has been a real issue. So, if we take recent history, we obviously had gold rally, in the early days of COVID disruptions with, heavy global stimulus. Gold miners rallied and then have given much of those gains back over the last 2 to 3 years because their costs have increased, and therefore compressed margin. So, I think we're in a scenario now where, if you look at the last 20 years, say, gold has actually been a very strong investment. Gold has returned annualized a little over 9% per year over that 20-year period. That compares to US S&P, which is clear focus, which has returned about 8.3%. So people are looking at gold saying, yes, it's been a good place to allocate capital, but then if I put money into the miners, they've effectively underperformed that. So if we look at that kind of recent history and snapshot of where we are today, cost pressures were a real issue over the last couple of years, but similar to the wider economy, we're seeing those cost inflation pressures really starting to ease now, and in many cases actually reverse. So inputs to that would be things like energy, would be things like consumables, including things like steel, acid, etc. But also labour. So labour is a bit more sticky. If we look globally, particularly in countries like Australia, labour was very tight for coal miners over there, and they saw heavy wage inflation. Now, a bit more anecdotally, we're definitely kind of seeing those pressures starting to ease. In part because it was sort of post-COVID disruptions, and people simply weren't turning up for their sort of fly in, fly out jobs because they're able to get better pay elsewhere. But we're really starting to see those pressures starting to ease. So, that leaves us in an interesting snapshot for the gold miners, because we had a more recent leg up in gold from 2000 to the 2350 level that we talked about, which occurred through March, so at the end of the first quarter. We're now moving into companies starting to report on the second quarter, or starting to report operationally rather than financially. And this is going to be the first quarter they're going to have received this higher gold price. But at the same time, those cost pressures that they're seeing have materially eased. So our expectation is, as we start to see reporting over the second quarter and third quarter, that this should translate to higher revenues actually feeding through into better margins and better free cash flow generation. And ultimately, that is what drives the miners. They're driven by earnings, not just the headline price.
That was Rob Crayfourd from the Golden Prospect Precious Metals Fund.
Now, sorry, Charlene, I know from your intro just before that interview you said it was the last thing, but I completely forgot about your Instagram thing, which I promised at the start of the show. So basically, this is an admission that you spend all day long looking at social media, but you found an interesting investment angle on there. So what caught your eye?
Absolutely not. I was on the train down to London, and in between working, I had a little break and a bit of a scroll. And I do follow quite a few different fashion accounts, including resale companies. So this is where you've got a lovely handbag that you feel like you've worn and had your best out of it, but you can resell it onto other people, and these kind of shops, if you like, or their online shops will take a cut and they'll find willing buyers. Now, I've seen some quite spurious claims on there lately that handbags over the long term are doing better than stocks. And some of the US best ones saying, my Hermes has outperformed my husband's stock portfolio and all that. And now I was thinking it was quite interesting because I don't think we could ever make any of these claims comparing handbags to shares. But we have seen huge price rises. So people are looking at some of these handbags, which can be priced in sort of tens of thousands of pounds if you're looking at a Hermes, Birkin or Kelly, and thinking of them as investment. And then their resale value is just holding so they can sell them on. And I think looking at Chanel, for instance, prices are rising and rising, with the Chanel Classic Flap doubling in price since 2016. So, I mean, I've not assessed the claims. I won't be going into too much detail on it, but it's an interesting angle. And obviously we've seen results and changes at luxury fashion houses such as Burberry in the last couple of weeks. So it's an interesting one to keep an eye on when I'm going on the train home.
I think it is an interesting one, but it's like, surely these things move in and out of fashion as sort of goes by the name. I think people always used to talk about art or sort of fancy cars, increasing in value. And then it was things like if you got an old Star Wars toys in your loft or something. Yeah. But I've got the impression with things like, luxury goods and sort of handbags and stuff, there's actually a lot of people seem to be buying them simply thinking that they want to go up in value, not as a functional product to use.
The old handbag hedge, I suppose. But yeah, no, absolutely. And when you look at these resale websites, it's all about whether it's pristine, whether it's still got its dust bag, whether it's still got the box, the original paperwork that it came with. Now, I'm a handbag fan. I've got a couple at home, but I definitely haven't kept all my boxes and all the documentation. So, definitely more about enjoying than the investment for me.
Well, that's all from us this week. Don't miss next week's show. We'll be talking to Will Easton from Aviva about reflation. We'll also hear from our very own James Flintoff about the performance of AJ Bell's funds. Until then, thanks very much for listening. It'd be amazing if you left us a review of the podcast. We'd love to hear what you think of it, and we'll catch you next time.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.